Welcome to Manhattan 5, August 27, 2026. Here are the 5 developments that matter. Number 1. Nvidia didn't just beat, it doubled. Nvidia reported quarterly revenue of $96.2 billion, more than double the prior year. Data center revenue reached approximately $89 billion, and next quarter guidance came in at $108 billion, above expectations. Shares initially rose almost 5% after hours. The demand is real, but Nvidia is also helping assemble financing pools, guaranteeing infrastructure commitments, and investing across the ecosystem buying its technology. The Manhattan view: strong chip demand does not prove that every data center or AI borrower will generate an adequate return. The underwriting question is how much demand exists independently of Nvidia-supported capital. Number 2. AI is now powerful enough to lift interest rates. South Korea raised its benchmark rate by 25 basis points to 3% for the second consecutive meeting. Inflation and housing pressure were part of the decision, but so was an economy accelerated by AI-related semiconductor exports and investment. The Bank of Korea raised its 2026 growth forecast from 2.6% to 3.3%. AI may eventually reduce costs, but building the infrastructure requires chips, engineers, electricity, land, and construction capacity. In the near term, the AI boom may be inflationary before its productivity benefits arrive. Number 3. The Treasury has started managing the long end. The Treasury doubled purchases of older long-dated bonds from $2 billion to $4 billion per operation. Whether described as a buyback or liquidity management, the message was clear. Long-term borrowing costs may be approaching a level policymakers find uncomfortable. Gold moved above $4,600 an ounce, while gold and Bitcoin benefited from concerns about deficits, currency debasement, and intervention in bond markets. Investors are asking not only where rates are going, but whether governments can afford to let markets decide. Number 4. The Fed now faces the wrong kind of choice. U.S. core inflation rose 0.2% in July, keeping price pressures persistent. The Federal Reserve must balance inflation above target, long-term yields testing government tolerance, an AI investment boom that may add demand, and asset markets expecting continued support. Cut too early and inflation, bonds, and the dollar could react. Stay tight and AI infrastructure, housing, and government borrowing become more expensive. Raise again, and the Fed may expose leverage that has accumulated outside the banking system. Number 5. Fifth story, not provided in source. The supplied source ends after the 4th development, so no 5th market story or original heading was provided. The Manhattan bottom line: AI demand remains powerful, but the next phase is about financing quality, inflation, long-term yields, and policy limits. Extraordinary growth does not eliminate underwriting risk. It can make that risk harder to see. Stay informed, stay liquid, move first.